1, 2.
Hello, everyone. Appreciate a lot of people have just had lunch, so we'll try best to wake everyone up from their post-eating slumber. So thank you all for being here. We've got a very esteemed and exciting panel. So we're speaking about beyond Series B, growth capital, and capital markets. We have an illustrious panel over here. So starting with Dave. Dave is an investment manager at Schroders Capital of their 500 million plus fund dedicated to investing in the best opportunities in the UK. His name is English. It sounds a mix of Scottish and French, but he's actually Brazilian. And as a self-proclaimed tech nerd, he witnesses seeing his colleagues' amazement at AI capabilities as seeing two of his good friends finally meeting and getting along. And then we're also joined by Katharine Spooner, who is co-founder and general partner at ROSC, early-stage venture fund founded in partnership with Mark Fuller, founder of the Monta Group, and she's also a huge aviation specialist. So maybe I'll pass it to the two of you just to give a bit more introduction on yourselves. And just very briefly on me, Karn, Dasgupta, I am at WestCap. We're a growth equity fund. I lead our European investments, and we invest from Series B to pre-IPO. So maybe if we start off with yourself, Dave.
Yeah, it's working. Sure, so I'll give a little bit more light. So Schroders has been investing in venture capital since the mid-90s. And by venture capital, I mean venture capital, growth, and whatever that entails. Since the mid-90s, we've been investing in, with, alongside names like Lightspeed, Sequoia Index, Excel, Andreessen, you name it. So we're right now in our vintage 12 of that, where we do 50% primaries, LP tickets, and 50% is going to go into co-investments and secondary opportunities. However, I work at the UK office, where we won a few of the Mansion House mandates. So we raised just north of 500 million, and we are doing roughly 70 to 80% of that is going to go into direct investments, all Series B onwards. And I guess we're going to talk about this, but we do both growth and late-stage venture capital. So that is great growth companies, as well as sort of great software businesses that are growing sort of over 50%, but not necessarily your immediate sort of exponential curve. Yeah, that's a little bit about us.
Awesome. Can you guys hear me? Hopefully. So as Karn mentioned, I'm Kate. I co-founded ROSC, which is an early stage venture capital fund investing on both sides of the Atlantic in security and prosperity, which today in pretty practical terms means a lot of defense. My own background has been both within growth and venture. So Karn and I have crossed paths for many years now. And of course, I know Schroders as an amazing LP. So yeah, that's my background.
All right, thank you. And maybe just to kick off the discussion, the growth landscape has profoundly changed since 2021. Companies that were flush with capital now cannot raise a Series C or Series D at any price. Is this a temporary dislocation or a structural change in the market we're seeing? Why don't we start with yourself, Kate?
Yeah, so I am of the belief that this is a structural dislocation. And I think the reason for that is twofold. First of all, if we look back to 2021, a lot of these companies at growth stage were financed in a zero interest rate era. And so now with rates having increased, it's very difficult to make the math work for later stage growth companies. Second of all, the exit market within Europe has also considerably changed. So for example, last year in 2025, there were predicted to be 6 IPOs within Europe, but only one of those companies, which is Klarna, IPO'd. The last time I checked, Klarna's stock is down about 65%. Could be, plus minus a little on that. And so the exit narrative within Europe has become a lot more challenged. And I think part of this is a factor that I'd be curious to hear, the rest of the panel's take on this, is that the abundance of US crossover funds that really underpinned all the significant deals in 2021 and 2022, such as Tiger and Co2, as big examples, they simply aren't investing in Europe anymore. And so that US crossover fund allocation is no longer underwriting the really large, significant rounds. And many of these significant rounds propped up companies that then went on to pretty much struggle. So if we take, for example, the grocery space, I'm sure everyone in this room remembers Flink, Zap, Gorillas, Getir, you could kind of go on for a while. They were often financed by these large American firms. So that, I think, has a major impact, that withdrawal of capital. Equally, there are, as Karn can relate to this, working at a US firm in Europe, there is still, of course, US capital at growth stage. I'm just not sure if it's as sort of abundant as it was in 2021.
Yeah, I think one of the things I would agree with the most is the interest rate part. But I also think that the bar, the quality that we look for has massively changed. And it just so happens that it coincided with the low in the cycle. So I've spoken with a few of my colleagues who do later stage venture and growth, and their perspective on a company that is growing close to 100% year on year is this is not good enough for us anymore. So all these companies, some of them are great businesses, but the valuation no longer match what great looks like anymore. So this is one of an issue, but I wouldn't even say it's an issue, right? It's pushing the industry to different levels. And the second part is in 2020 and 21, because of the interest rates and the market activity, the thinking was growth at any cost, and the valuation will come. And the valuation never came because of this, because of the shift. We just thought that spending more money, hiring more people, more marketing, more go-to-market, more sales, and eventually would make sense. However, now we know that with the works of AI and with the technological advancements, that this is no longer necessarily the case. So I would argue that is just a technological advancement that shifted the curve all the way to the right.
I think those are excellent points, and particularly to the point around how the financial conditions in 2021 made the investment environment so divorced from the operational reality and had the broken unit economics that you mentioned, Dave. And I think just to add to that, I think it was certainly a lot of US crossovers, but also large investors from Japan, sovereign wealth funds. And I think that really did distort the growth market, which has taken years to unfold. And I think we're slowly getting in a healthier place. And I think AI has also been a very fascinating, different operational dimension, which we should dig into later. But I guess if we move on to, there's been a lot of focus on more capital-intensive industries as we see advancements in deep tech and defense and so forth. Kate, conscious that this is a space you're actively looking at, which is drastically different funding profiles to the asset-light technology profiles that a lot of growth firms such as WestCap look at. How do you navigate that when a company is too advanced and too large for early stage VC, but not quite at the stage that growth firms would look for?
That is such a great question, because to your point, I think it's particularly relevant for companies within defense. So ROSC looks a lot at defense companies under the theme of security. And I think there are a couple points that really stand out to us. Number one, when companies graduate from venture funding to growth funding, and it might be, to your point, a little bit challenging to get that growth funding, I think part of that sits with the investors because the decisions that are made within the company in terms of product market fit, growth, marketing, really would have come up at a board level at seed and Series A. So once they graduate to Series B and might need more capital but aren't able to secure that capital, I would say that is a board perhaps set of decisions that could have been made earlier. That said, there are a set of companies that don't look like the profile of typical venture companies, and I think we have to ask ourselves, okay, so what is that profile of typical venture companies? And historically, at least for the last 20 years, those have been the software companies. Software companies is sort of what brought venture to the fore in the first place in the 1990s with the dot-com bubble, and that has been the bread and butter of venture in subsequent years. Then, of course, 2 or 3 years ago, there's been this significant shift of two types of companies that have different capital profile footprints. One are defense companies, and second of all, and I would label deep tech within that bucket as well, and then second of all are the AI companies that might require an enormous amount of capital to get going that simply can't be sustained within the typical funding round formats. And the big sort of pain point behind this, and I see this a lot at ROSC when we're speaking to potential LPs, is saying, okay, well, the typical fund cycle is 10 years long. We're investing in companies that may or may not even make money within the first 5 or 6 years. How can we look after your capital and give the capital back to you within that 10-year cycle? It's very challenging to be able to not just like put that in the documents that go into a venture fund, but also be able to articulate that to LPs who want liquidity, who want DPI within that time frame. So the way to mitigate this, or I suppose to get around it, is first of all, be very clear on your investment remit of what that hold cycle looks like for companies. So there are some funds that have atypical fund terms. Instead of a 10-year period, there might be something a little bit longer. And then second of all, from a company perspective, I think once you make an investment at seed, pre-seed, there needs to be, and typically there is with venture capital ownership structures, but there needs to be a set of really kind of honest, clear questions with the founders, with the early leadership team, as to what each round looks like. And the challenging part of that, of course, at seed is that the company might pivot. You see this a lot within defense, actually. And so there's a degree of sort of board investor management and duty that comes at that early point to make sure that the company is on a sort of an agreed track to either reach various rounds or generate an exit at some point.
I think there's so much to unpack around that, and it is fascinating, particularly in deep tech and those sort of more capital-intensive industries where there is that long lead time to material commercialization. A lot of investment is needed to build out the tech and the IP, but the fund structures are still typically 10 years. At the same time, we're seeing IPO timelines extend out, and the scale you need is far greater than what you would have seen in the past. Are you seeing, particularly in deep tech, more conversation around late-stage secondaries and alternative paths to liquidity as you try and deliver DPI to your investors within a 10-year time frame? Is that something you guys are thinking about?
Absolutely. So we see two big changes. One is the abundance of secondaries firms. So as I'm sure everyone in the audience knows this as well, but the number of new secondary firms targeted in Europe, I don't know the actual stat behind it, but has really significantly increased because there is this underlying knowledge that there's sort of more pressure for VCs to generate DPI on a faster time frame, especially because, as you mentioned, the exit window for IPOs is more challenging. And then second of all, I would say that very kind of generally speaking, it becomes much more, I think there needs to be a much more sort of open conversation with how to be able to sufficiently exit a company and to be able to generate that DPI. And it's either, as you mentioned, through secondaries, or alternatively, there are other paths. The European M&A landscape has endured in a way that the IPO window hasn't, for example. So I think there's a component to that as well.
Very helpful. And then Dave, at Schroders, you have such a unique vantage across not only the portfolio, very extensive portfolio companies you have, but also through your interactions as an LP and the vantage point you have across different funds on a global scale. And so the question is, when you look at the growth landscape, you know, you have a huge myriad of companies from, you know, large sovereign wealth funds who will be great anchors into the IPO. For example, at WestCap, our angle is that we can provide a lot of operational support at the growth stage. You have sector specialists, people who are geography specialists. Do you see the type of investors that enter into the companies having that impact on how outcomes are delivered and how they interact with those companies themselves?
Yeah, I think I would be lying if I said no. I think everyone in this room understands that the brand of your investor, the type of investor, can meaningfully change the outcome that you can get. But I want to separate here just 2 seconds. There is an outcome for the ecosystem, which is that the best companies are often backed by the top tier investors in the world. It's a bit of a vicious cycle, but these elite groups of investors are often access restricted investors themselves to get access as an LP. So what happens is these companies that do go on to become quite successful themselves generate massive liquidity events to this top tier investors. However, it's what happens to these LPs, right? So as a European community, UK European community, what we are trying to do is make sure that there is a broader access as LPs to these top tier investors. So that, for example, what we are trying to do with Schroders right now with the Mansion House Act is give UK pension funds access to these extremely access restricted funds. So that it trickles down and the whole economy can benefit from these massive scale opportunities. And the second point is what happens with these investors is there are benefits, pros and cons on all of those. I do think sovereign capital can be a great form of money for companies. That is because there's patient capital and a lot more pots of capital that have different dependencies. However, what it is important for companies to realize when they do accept, when they go on to choose their cap table, is understanding where they fit in the risk-return profile of every investor. It is important to match where you are in your journey with how your investor's thinking of you, which is why a venture capital and investing at a more stable company doesn't really make sense, because in order for the funds to work, you need to take bigger risks for bigger returns. So you're going to do things there a different way. For sovereign capital, it's a little bit the same. It comes with more patient capital, but it can come with maybe a lack of understanding on certain elements that is important to push the company further. And one thing just finally is being able to have a little bit of both the brand recognition, but also the boots in the ground. I think in Europe, we end up kicking ourselves quite a lot in terms of why is the US having more success cases than us. I do think Europe is producing a lot of great companies at the moment, great funds that understand everything that is going on. The one thing that we do come across a little bit, if we're being honest, is in my past experience, I used to do business development for a startup, and the conversations that we would find between the London office with the US office was always the US corporations being a little bit more open-minded to try new products. The ACV is a lot higher there. but those are enterprise, and I think Europe is very good for the SMEs. So it's understanding where you fit. If you are an SME focused, if you're an enterprise, a software that sells to enterprise, having access to the US quite earlier on is going to be detrimental. It's going to be crucial for your journey. Whereas if you're selling to SMEs, perhaps the journey to the US can wait a little bit longer. So choosing the geography of where the capital is coming from, the investor base, and where they view you in the risk return profile is absolutely crucial.
That's really helpful, Dave. And I'm thrilled also you mentioned around the Mansion House reforms, because if you look across Europe, we're having a pension crisis. And this is a slow, oncoming train. And if you compare it to, sovereign wealth funds or pension funds in the US and Canada, where more and more value is being created in the capital private markets, it's something that we need to address. I guess if we look at the other side of the curve, and thrilled to have Chris Godman, who joins us here. He leads international equity capital markets and tech advisory at Standard Bank. Would love to get your perspectives on what is needed for a company to go public, and what is that bar to IPO?
Hey, thanks for that. And sorry I was a bit late. I was actually waiting in the wrong room for a while. But sorry, there we go. You can all hear me now. Yeah, so unfortunately I was in the wrong room, just waiting to queue up in the next door's one, but I'm now back. It's an interesting question, and I'll start with some myth busting. Look, I'm an equity capitals market banker, and I'll be very honest, I haven't been very busy for the last 5 years. I've managed to hang in there and still have a job now, thank God. And it's a very exciting place to be, because actually over the course of that 5 years, we've seen phenomenal entrepreneur-led businesses move from great ideas at pre-revenue to actually now high-growth revenue businesses with moving to EBITDA positive and cash conversion, which I think is the first kind of key benchmark for getting to the London markets or the international capital markets, but then also then going to profitability and potentially earnings per share and dividends and showing real returns beyond just capital growth. So on to myth busting. So a lot of people, when we think around, certainly from the technology space, there's always a lot of hope around the big strategic buyer, the business combination, the otherwise. In brutal honesty, when you see how much of, certainly from my perspective, from the Africa space, the amount of deal flow that gets done in that area is very minimal. The size of checks that we've seen from strategics in the African technology space have remained quite small. Now, the number of unicorns in the African space is only growing. So last count, depends which watch you're looking at, it's 12 to 15 unicorns. So let's take a conservative estimate. They're all worth $1 to $2 to $3 billion now. That's 25, 35, $45 billion of liquidity that the market's going to have to find. Now, on the basis of venture capital, private capital that's been raised, there is simply, and also strategic activity in the space, we're not seeing that kind of liquidity flow, so the public markets have to be there as a home for these companies to grow. And actually, when you think around technology and what it's around people. This is monetizing people and changing the way that people do things. These companies should be in your customers' hands. That's the real bonus about coming to the market. Putting your stock in the hands of the people that make your companies great. So I think that this is a natural home. We benchmark private processes versus IPO processes. In general, private processes tend to take longer these days. It's not actually the fastest way to capital, certainly not in the Africa space. So when is the right time? As I said, there's kind of the triangulation of perfect valuation, which is showing 30 to 40% plus revenue growth, the moving to EBITDA break even, so you've got eyes up the P&L and eyes down the P&L, and then obviously a pathway to profitability, because people, while there's been a lot of hot money in the space, I think people now understand that really actually buying growth at any cost is not the right way to hitting a successful valuation. So I think the IPO process can come much, much closer. I think a good idea for all companies is to think around, how do I act like a public company today? Think about your KPIs, get them onto your website, talk about customer acquisition, look at the public companies you're competing against or trying to become or to mirror in the future, Look at their KPIs, start reporting on them, think about it in that way. Because actually, if you're coming to a new group of investors for the first time and you're having to tell them that story, you've kind of lost the battle. What they really want to focus on is what's next. So there's a lot of things you can do. I think the journey should always start from the outset. You should always be thinking about your liquidity objectives from the first order, but always keeping really, really strong focus on demand tension and sources of liquidity, because they're constantly evolving, be it even the institutional investor base. I mean, Schroders, you've got a crossover fund now. These are all things that are new advents that when I started banking 23 years ago, when I didn't have white hair, they weren't even things that we even thought about. And there's a whole blurring between the public and private lines, and it's an incredibly exciting place to be. I hope I can keep up with it, but it's moving so fast. And, as entrepreneurs and participants in this space, you've got to be alive to it. And, luckily you have great people like we're on the panel with today who can sort of help you on that journey.
Very helpful. And then, if we go beyond, before public markets, but as you're crossing the chasm from early stage venture to growth, at least from my vantage point, we invest at the growth stage, but we speak to founders very early, build those relationships. And there's a lot of misconceptions as you make that chasm. So for the room, for those founders, companies, or those advising them, I would love for each person to give what is your most common misconception you see, and what's your snappy advice you would give to the room? So Kate, why don't we start with yourself?
So the advice that I would give to founders about so I understand the question, the misconception between evaluating them at early versus growth stage, I think is really one thing, which is at early stage, the majority of due diligencing a company is purely on the founder, who they are, their background, what made them found this company. It is such a founder bet at pre-seed, even seed. And then anything after that is a metrics analysis. And that, I think, kicks in at Series A, certainly for other sectors, maybe a little earlier. But what I mean by that is everything, not just the P&L metrics, but all the other operational KPIs that can be properly measured. So that's anything from retention with a software company to procurement contracts with a defense company, and that numerical analysis is so important. So my advice would be to over-index on how much you can show the number progress beginning at seed stage.
Great. Why don't we go to yourself, Dave?
Yeah, so two things very quickly. One, valuation does not equate success. So my recommendation and suggestion is don't go chasing purely the highest valuation. And the second one is the difference between venture and growth is that at growth, you stop looking for necessarily that future what if. The analysis, as you pointed out, is very much on the basis of repeatability. It is KPIs, it is hitting the metrics constantly. We are underwriting resilience. We are underwriting from here on out. We expect you to keep on things pretty much the same and without that much more of a change. In venture, you can underwrite a lot more. The what ifs, the products that will only happen in the future and the expansions that come with it. So those would be the sort of thinkings that I would have when you're speaking with a venture investor versus a growth investor.
You did actually still, I was going to go with don't go chasing multiples as well, but unfortunately I'll have to come up with something new. So what I would say is keeping one eye on your liquidity journey, I think, at all times. So this is one of the hardest things that we always see, is that the liquidity bottleneck in the system is huge at the moment. And it's not actually, I don't think, necessarily linked to sort of a lack of capital or a lack of opportunity. It's actually, I think we have we need a bit of a valuation reset. I think that people need to understand that valuation is more than just a point in time. If you really believe in your company, the valuation that gives you the capital to drive your growth is the valuation that's right. And ultimately, it's down to the founders in the room. You don't need to sell your company today. You can keep holding shares. You can keep growing with your company. And that valuation data point, that's in the past, the moment the deal's closed, and you can focus on your growth. I guess the only last thing is keep all eyes on all sources of liquidity, because there's going to be a lot more innovative platforms for liquidity that I'm expecting that will be launching, certainly in the Africa space, over the course of the next 6 to 12 months. That will be very, very exciting, very interesting for the institutional retail customer base. So I think that the world is going to change to hopefully try and shift those bottlenecks. Not necessarily solve them, but certainly shift them.
Brilliant. And then if we look to the future, okay, I think it's working now. Brilliant. And if we look to the future, what does a healthy European growth capital ecosystem look like in 5 years? And what do you see as the main obstacles? So Dave, why don't we start with yourself?
Yeah, for me, the most important part is, I go back to the LP landscape, is European institutions and the Europe and UK is European institutions and the population pension funds being able to access directly or indirectly the best opportunities. And by opportunities, again, it is both these hyperscalers as well as very, very solid technology businesses. For me, this is what success looks like. And apart from that is being able to, I sort of very much second that thinking, that is creativity, financial creativity. For me is alpha is being created at the moment, either by picking one and or two of these things, which is access and creativity. When you're speaking with investors, access being access to the best companies, the best funds, etc., and creativity being where are you seeing the best opportunities at the moment. If you can do the hyperscalers, but you can also do these great solid technology businesses, if you can entertain secondaries, and if you can do pre-IPO, but you can also partake in some other forms of capital, I think that is very much where I think Europe is really gonna unlock, and that's where success will come from.
Thank you. So we've seen it from the LP angle. If I switch to the GP angle, I think part of where Europe will be in 5 years' time, and wish I had a crystal ball, but is so dependent on macro economic policy. And by that, I mean a few things. Is it going to be the case that European governments meet their NATO commitment? Seems like it, given the current US administration. Is it going to be the case that there'll be more public money allocated towards venture? Again, seems like it, given the backing of players like KfW and EIF. So there's that component, which is what will the macro landscape look like? But then if I answer more practically, best case outcome for GPs, I think that there will be two types of firms that will really endure. One is the spate of really excellent firms that we're all sort of aware of and have helped underwrite a lot of the European success stories today, like a Sequoia, for example. And then I think second of all, there will probably, and we see this already taking shape, a spate of GPs that are highly specialized in their particular swim lane of investing in a particular sector and or in a particular geography where they're able to provide a value add to their founders. And this sort of niche emerging manager has done really well in the US. So if you look at firm returns in the States, the managers that are performing in top decile are often first or second time fund managers. And a big part of that is because they have so much skin in the game and they really want to prove themselves in their first and second vintages. So I suspect that will be the case increasingly in Europe, that we see much more of an abundance of really focused managers?
I'm probably going to get beaten to the floor by the two people next to me in a second. But I think actually, so where I would start with in terms of what creates a healthy sort of world and ecosystem for the European venture capital market, it's actually looking through the funds and looking through to the underlying companies. I think that there's a big onus on countries to be much more tax efficient or tax promoting for actual companies. So, for instance, come and domicile in the UK will give you tax breaks for the next 10 years because actually you wouldn't have been here otherwise. You'd have been in the Cayman or Delaware or somewhere else equally exotic and probably better for a holiday. But so I think that's one place. And then coupled with that, because we're quite good on a fund level, we do have venture capital trusts, et cetera, that are all great tax efficient instruments, but does that always flow through to the underlying? And that's a question. So it feels that the system works, but only to a degree. So I'd like to see that flow through to the final end use beneficial user. Outside of that, I think geographies such as the UK, which is the prime example of a great market with great investors that doesn't really invest in its own companies. I think to see more positive moves from regulators to see people invest in growth companies and in the stock market. So more captive money to London, more captive money to Amsterdam, more captive money to whichever growth market or stock market you want to see. By doing that, you breed growth. And also with inflation continuing at sort of African levels, which I'm obviously more au fait to, we need stronger capital growth in our own pension funds today, I think, if we're going to keep on beating inflation of moving to mid-single digits.
Brilliant, and I would certainly echo that all. And I think it's a multifaceted issue, and coming from a transatlantic fund perspective, the number of European founders we see who relocate to the US, and the more we can do to incentivize them to stay, build, and scale, and have all the underlying infrastructure for them will be greatly additive to the ecosystem. But thank you to everyone on the panel for joining for such a great discussion today.
Thank you.
Right.